Good afternoon, everyone, and thank you for reading through those disclosures, and welcome to another one of Avant-Garde's free educational trading webinars. We are happy to host guest presenter Vlad this afternoon, and he is also joined by co-guest presenter Keith Harwood, and they're going to be talking to us all about how to play earnings season volatility to your advantage. The presentation topic today, and we are excited to get going. Vlad, Keith, are you with us?
Loud and clear. Yes, thank you for having us.
Yes, thank you for having us.
Wonderful. Thank you both for being here. Vlad, if you want to go ahead and take control of the screen and pull up your presentation, feel free to do that. While you're doing so, I will just remind everyone live in the Zoom room, if you have questions during the presentation, please feel free to type those questions in the chat or the Q&A, and I can get them over to Vlad or Keith to address at the end. All right, Vlad, I can see your title slide, so feel free to begin when you're ready.
Perfect. All right. Thank you very much again, Natalie and AGT, for having me. Today we're going to talk about current market volatility. You have volatility as a result of earnings. Earnings season is out. Second week we had earnings from major banks, from regional banks, from investment banking, from some of the energy stocks and healthcare stocks. And then you have uncertainty macroeconomic, right? We have this week where we're about to take over Greenland, and that created volatility in the market, and it looks like there is de-escalation in some of the rhetoric and mutual understanding. So these events gonna happen. When the events happen, volatility is rising, and we're gonna talk about how to take advantage of that, of those volatility. And one is kind of a black swan events where you cannot predict them, like taking over Greenland, or Microsoft earnings next week. So we'll give an example of both. For those of you who are new, let me see. Do I see familiar names? Alan, Farid, John, Mark, Marcus, Michael, Paul, Vita, welcome back. Thank you guys for joining. This is great. For those of you who are new, some of you are new, my background is computer science. I worked as an executive and CTO in several publicly traded companies, Options Express, several broker dealers, hedge funds, and started managing my own money over 25 years. Was concentration in analytics, artificial intelligence, financial modeling. We have a team of financial engineers that are constantly taking advantage of all the innovation we have in AI and financial engineering in the past few years to provide signals in the market. So I've been doing that for over 25 years. And Keith Harwood joined me about maybe 2 years, almost 2 years ago, or about 2 years ago. And Keith, you want to give a little background about?
Yeah, absolutely. So my background's a little different from Vlad. I started as a market maker down in the CBOE pits about 20 years ago. So I traded through all sorts of market conditions, of course, the subprime crisis for those that have been trading for a while. My expertise is generally in the option space as well as pricing volatility. And so, things like earnings are always very exciting for me because, we traded very actively around earnings for all the names that I was a market maker in, and just, trading the volatility arbitrage and looking for expected movement and things that are really relevant for our topic today. I've also traded as a prop trader, as a hedge fund trader, risk manager, option strategist, and been in the educational space for about 9 years now. So a lot of really exciting stuff, though, that's going on in the options market, especially with all of this uncertainty, as Vlad mentioned, Greenland, and then earnings season now.
Very good. Thank you, Keith. Disclosures are very important. I'm going to go through specific trade idea, Microsoft next week, and we'll take Keith take on the Microsoft and Magnificent Seven stocks and just technology in general. Technology has been underperforming. Emerging market has been underperforming value stocks, small cap stocks. So is this kind of a year where tech is going to underperform? It's been leading the market in the past since 22. Or or it can get back into the leadership role. So these earnings, I think, is going to be extremely important. So I'm going to go to specific trade ideas. So it's very important to understand that I'm not neither Keith nor I are financial advisors. We're not here to provide financial recommendations. We're here to show you how we trade for general education and information purposes only. And you can always pause the screen if you need more time to read the disclosures. All right, so some background on volatility. What is volatility? Right. So historical, there's two types of volatility that we look at when there's uncertainty in the market due to earnings or due to geopolitical risks. One is historical volatility, right? So in the definition of historical volatility, just what it says historically, you can look at the past 50 days, past year. But it's realized volatility of financial instruments over a given period of time, right? Usually you look at the 1 year or you look at the 1 month. And generally, this measure is calculated by determining the average deviation from average price of financial instrument. Right? So basically, the more you deviate, right, if the stock moves 10% every day, like Moderna today in the past couple of days, or some of the meme stocks, then you can definitely see that this is a high beta, high volatility stocks, right? If you look at the Procter Gamble and it doesn't move, or average S&P 500 stocks moves less than 1%, right, a day. So then it's a lower volatility. So volatility just determines, just what it says. Implied volatility, when there is uncertainty, I always think about it as a future volatility, right? We're not sure exactly if there's going to be agreement about Greenland, right? It could always have a 360-degree turn, or if we're going to reach an agreement with China, right? China is supposed to follow their obligations or their promise on purchasing, soybeans and other products from the United States. They're supposed to evaluate that relationship this month. That could escalate again at any given point. Right, so there is always this implied volatility, future volatility, and it's measured. One instrument is VIX, right? VIX looks at S&P 500 puts activity, and the higher the implied volatility, the higher the price of the options, right? And the higher the uncertainty in the market. That's how I usually look at it. You can look at IV rank, right? Volatility change, kind of, you see, green light is IV percentile, right? 100% very volatile stock, Microsoft, compared to its historical volatility or where implied volatility have been. And you can see when it says earnings, right? You see spikes in this volatility. And then there's a volatility crash right after the earnings because uncertainty is rising, right? You can see going into Microsoft earnings, volatility is rising again. So it follows cycles, the earnings cycles, right? And if you superimpose earnings cycles with the geopolitical risk, then these green lines are going to be higher, right? So the higher the numbers, the higher the premium in the options. The smaller the numbers, the smaller the premium, right? So people look at the IV rank, right? Especially if you sell in premium, right? Ideally, when you sell premium, when VIX is the highest. I mean, not VIX, but implied volatility is the highest. When the implied volatility is 90%, right? Or reaching these extremes, in terms of ranking, well, then you sell in premium, right? Because the options are expensive, you justify taking the risk. When premium is low, implied volatility is low and the premium is low, then maybe it makes sense to buy puts and calls, right? Because you don't have to pay extra premium to express your directional bias, right? So very important role. This is Microsoft historical versus implied volatility. People look at the IV rank, IV percentile, implied volatility. Any questions? Keith, I know this is close to your heart. I have very limited knowledge of these concepts. I think you have much deeper understanding. Anything on the IV rank, how you use it, implied volatility?
Yeah, so I think the biggest thing that to understand with something like Microsoft is that even if the stock hasn't been moving, the fact that there is a fundamental input of earnings means that the IV percentile is near the highs. So the market knows earnings is coming and the market prices it in. What we're looking for in these scenarios is what edge do we have relative to the IV percentile, the IV rank, and the normal earnings move. So even though the stock may not have been moving that much recently, we know that this is an event that should cause some volatility, and that as a result, the implied volatility is likely to go higher up until earnings and then come right back down.
Appreciate it. Thank you. The other thing, that very important information that we all, at least I'm using, I know Keith is using, is the sentiment, right? What do other market participants think about Microsoft going into the earnings? And the way you usually look is put-call ratio, right? Is there more activity in buying puts? Is there more activity in call buying? And what's that ratio? And you can look at by expiration. And Keith's point here is that on this slide, you can see that when I took the slide, January 16 expiration, which already kind of passed, right? January expiration passed. You can see that implied volatility was only 4%, right? And then it's jumping as closer you get into earnings, 18%, and then 37%. That means that the range that the stocks is going to trade is going to widen, right? As you're going into the earnings. I think earnings is right. I believe it's January 28th. If I'm not mistaken. Yeah, January 28th. So January 28th is after market close, Microsoft is going to announce earnings. And you already can see when I took the screenshot before January 16th, on January 30th, the expectation is rising, right? Implied volatility is rising, right? And that's the relationship between volatility before the event or after, or going into the event. Because there's little uncertainty on January 16th, but there's a lot more uncertainty for January 30th. So if you're paying for the January 30 options, it's going to be a lot more expensive than paying for January 16 because January 30 expires right after the earnings. And I always look at the put and call ratio, right? And you can see going into the event, well, for January 16, there were a lot more call buying than the put buying, right? And after the event like dispute about the Greenland, who controls, and whether it's going to be part of the United States, there is a flow, right? People are, closing their puts, they're opening their calls, or vice versa. So that put-call ratio could also change significantly. So here, when you look at January 16 expiration, you can see almost 2-to-1 ratio between call buying and put buying. So people were at least at the time I took a screenshot, were very bullish on the Microsoft earnings, right? With the idea that the stock is oversold, AI demand is still great, and this is just overreaction, kind of digestion of AI stocks. And then, you've seen stocks like Seagate, right? The WC storage, hard drive storage space that you need for data centers, you need to run AI, they're going exponentially high. So going into the Microsoft, Google earnings, and other AI stocks like Palantir, a lot of people are expressing bullish bias. So by looking at that, you can see what the sentiment is, and do you agree with bulls? And because calls outpace puts 2-to-1, so if you want to trade with the crowd or with everybody else, right? It doesn't matter what I think about Microsoft earnings or what Keith thinks about Microsoft earnings. It matters what majority of the people think, and then you have a decision. Do you take a contrarian approach, or do you go with the direction of other people trading? Keith, anything on put and call ratio that stands out to you before Microsoft earnings?
Nothing major on the put and call ratio other than the fact that the weekly options that expire the week of earnings, there's obviously a significant difference between the ratio there where it's close to balanced, equal-ish number of puts and calls out there. So there's not as strong of a bias for the earnings itself. The week leading up or the 2 weeks leading up, people were certainly looking more bullishly postured.
All right, thank you. And then I think Keith alluded already, the idea of expected move, right? Historical moves versus implied moves. So look in Microsoft after market close on January 28th, it's announcing earnings, and you can see in the past 4 quarters what was the historical move. Average move is about 5%. As long as I've been trading earnings, Microsoft is about in that range, 5-6%. I mean, sometimes it moves 8%, right, to the upside. Sometimes it moves 8% to the downside. But, historically, the move is 5%, right? When I took the screenshot, going into the earnings, if you look at the options data, the supply and demand for, at the money or near the money options data, it basically shows you, now this is implied move here. right? The implied move is, you can see here, 4.72%, right? For January 16, I overrode this, but the expected move here is, oh, sorry, expected move is 5%, right? So same thing. When I took the screenshot on January 16, before January 16, there's very little uncertainty in market, so the expectation that Microsoft is only going to move 0.5%. As you're getting closer to earnings, January 23, based on supply and demand, right, implied volatility, future expectation, right? The screenshot was done before January 16. Now it's rising 2% a week before the earnings. And then 2 days after Microsoft earnings, right? 2 days, the January 30th contracts will expire. Now this is 4.9%. So historical move is 5%, and implied move is also 5%. Sometimes due to uncertainty, now if I look at I would expect more than 5% expected move because of the geopolitical risk and situation in Greenland, then it could be, 5.5%, 6%. So you always look at the historical move versus expected move, and you make a decision, right? If expected move, let's say it was only 2%, but historical move was 5%, again, maybe it doesn't make sense to sell the premium because you don't get paid enough, right? Maybe you want to take the other side and buy, puts and calls as opposed to selling premium and selling puts and calls. Right, so very important relationship, and this graph basically shows you when the earnings gonna occur, and again, distribution of possible outcomes by February 20th, by March 20th. You can see the range that the market participants think that Microsoft is gonna trade widens, right? The longer you have to wait. Keith, any words of wisdom on expected
Biggest thing
versus
for me here
implied?
is in a stock like Microsoft, this is usually going to be efficient. When I see an average move in a stock of, say, 2%, but the market pricing in 12%, then it starts to raise some questions for me and say, okay, well, why is the market expecting this to be significantly different from the past? Microsoft may be a little bit more routine, a little bit more predictable. And then the question then is, how can I take advantage of that if I'm not going to be strongly biased towards selling premium or buying premium? What can I do about that 5%? So there's always a good question to ask, depending upon if the market's in line with what I would normally expect or the market's out of line with what I would normally expect.
Perfect, thank you. And another way how I use this information is that even if, let's say, you're not an option trader, right? You only trade stocks. You might say, well, why do I care about this information? Well, by looking at the expected move and implied move, right, you can see if you have 100 shares of Microsoft, let's say, right, and Microsoft is trading, I don't know, on the screen, it's 450, 460,
Yeah,
right?
450.
Yeah, 450, 460. So 100 shares is what is it? $45,000, right? 450 to zero, so $45,000, right? And then you look at expected move 5%, and if you own the stock 5%, then you can basically go through these future rehearsal exercises and decide how would you feel if the Microsoft goes up 5%, right? How would you feel? Or what do you think about if it drops 5%, right? So if the 5% move based on how much money you own in Microsoft, you don't feel comfortable with, then it basically prompts a question, maybe you have too much exposure to Microsoft, right? Maybe instead of 100 shares, you might want to only own 50 shares going into the earnings. If you are comfortable trading options and you have a stock, maybe it makes sense to buy a debit put spread. Right now that you know what the expected move is, and maybe you're comfortable with 5% move, but you're not comfortable with 10% move, then you can buy a put spread, right? Some people, if you want to own more, you can do ratio spreads, right? We talked about ratio spreads last year, right? You can buy maybe one put to hedge your stock position, but then sell two more puts. It doesn't cost you much money. But you do want to own Microsoft if it does move, let's say 10% to the downside, right? So there's different strategies, and it's very important kind of to go through these future rehearsal exercises, right? To kind of go through this what if scenario. What if Microsoft drops 5%? How does my position look, right? Or what if it drops 10%, right? And that can give you at least opportunity to see if you have too much exposure to the stock or maybe too little exposure to the stock, but that is a very useful information. And again, just remember that trading is distribution of possible outcomes, right? I always like to show these screens because it's very important to understand basic statistics. One sigma move, two sigma move, right? If Microsoft moves 4 to 5%, that's a one sigma move. 70% of the time it moves within 5%. If it moves, 10%, it'll probably be two sigma moves, right? Or three sigma moves. If Microsoft doesn't move 10 to 15% during earnings, right? Unless there is some kind of a big catalyst like we've seen in Oracle, right? Oracle usually doesn't move 10%, but it moved, I think, 30 or 40% during last earnings because they showed this huge backlog of everybody who wants to, use Oracle platform for the AI, right? But whether you do have earnings or you don't have earnings, encourage you to always think about, okay, stock is trading here at you. What is the range that it can move, right? You can look at the options data with or without earnings to determine by certain date or by certain time frame, whether it's 1 week, 2 weeks, 1 month, 6 months, a year, what is the range that the stock could be trading at, right? And this is just, distribution of possible outcomes, right? You roll two dice, just remember, 7 happens 70% of the time. So more often than not, if Microsoft is trading at 450, 50% of the time it's going to trade, in this 4% range, right? And that's what this chart intends to show. So you can do different strategies. So how do you take advantage of the Microsoft trade? What is the different strategies? I like spreads, right? You can do spreads where you sell put spread. Let's say Microsoft, volatility is elevated, and I don't think Microsoft is going to sell off more than 5%, right? Then I can sell a put spread, right? If I don't think Microsoft is going to sell more than 5%, then I can sell out of the money put spread and collect premium, right? The VIX is still elevated. You have implied volatility higher. And in this chart, basically, here we're looking, this is usually Keith likes at least, 20 to 30% risk versus reward. Here, the risk reward is 3 to 1. So you can do a $10 spread, right? You can do a $10 spread. You can sell, in this example, which strikes 445. So you sell 445, 435 strike. You look at the supply and demand of option contracts, and actually, let's look at that now. So I'm gonna go to trade option. I'll take in trade option chain. Microsoft. So it announces earnings on January 30th. So it's trading at 450 right now, right? 5% is about what, $22. So 430, 435. Then I look open interest, right? Where's the highest open interest on which strikes? Looks like 430. There is a lot of open interest at 430 strike, right? Which would imply 5% move 22, right? So around 430. So you can see highest open interest is at 430 level. So maybe it makes sense to sell 430, right? And buy 427 spread, right? I can collect 55 cents. If I don't think Microsoft is going to move beyond 5%, maybe I can do the same thing on call spread. And in this example, if I can collect 50 cents on puts and 50 cents on call spread, then I'm gaining $1, right? Dollar is my maximum profit, and the risk it's a $2.50 spread, so I'm risking $1.50, right? So reward dollar, maximum risk $1.50, assuming that the Microsoft is not going to move. In this case, would be below the 427, 430 strike, right? If it gets to 428.50, you break even, but if it gets to 427.5 and it stays at 427.5, then then this would be a losing trade, right? And we're going back to basically four earnings, going back to April of 25, right? If it breaks that level, right, and closes this gap, then this would be a losing trade. And you can do the same thing analogy on the upside. It's below 200-day moving average, below 50. You have this, what is it, black cross, death cross, where 50 is below 200-day. If you don't think we're gonna get above that cross on the earnings, then okay, you can go in and sell the call spread as well. Any questions on Microsoft and different strategies? And again, this is if you think that the implied volatility justifies taking the risk. If you think if you think Microsoft is going to move 10% up or down, well, then you can buy straddle, right? You can buy put and call because the implied move is, you think it's going to be more than what majority of the people think, right? That's how I would approach this. If you think that market underestimates the volatility or how much the stock Microsoft will move, then you can buy call, buy put, or both if you don't know what the direction is or you don't have a strong opinion on direction. But you basically doing debit transactions. Some people do directional butterflies, some people do calendar spreads, but some kind of a derivative of these spreads. But this is risk versus reward. It gives you maximum profit, probability of loss, right? Because you're selling out of the money options in this trade. 30% of the time you will be wrong, 70% of the time you will be correct. And it's a repetitive process. As long as your wins and losses are the same amount, then you can see this strategy will yield, over a longer period of time will give you profits, right? As long as you don't, on the 30% that you're on, you don't lose more money than on the 70% of the time that you're right. And to summarize that, we can go to Winston. I don't know if I lost that slide. No, it's still here. So I said, what is the most optimal option strategy to take advantage of Microsoft, right? This is AGT platform. You can look at the option chain, open interest, gives you analytics, but you also have AI agent that's optimized for broker dealers, optimized for financial industry. You can say, what are the most optimal option strategies to take advantage of Microsoft earnings next week? And I like the answer. Earnings season is a playground for option strategies, and Microsoft upcoming report next week is set to ignite volatility and opportunity, right? You always want to look at the AI agents and make sure that somebody validates the answer, right? Because sometimes, especially some earnings data, Keith pointed out, sometimes it's a little off on data. So just be careful and it's not just Winston, any AI agents, right? This is still kind of a work in progress. And it's basically so earnings typically trigger sharp moves up or down, making options an ideal tool for capturing both directional and volatility-driven opportunities. Here's a concise breakdown of the most effective strategies tailored to current market conditions and Microsoft technical setup. Straddle. If you think Microsoft is going to move 10%, then all you do is or at least more than what majority of the people think, right? Majority of the market participants. Then you buy a straddle, right? You buy a put, you buy a call, and and then you'll make money. If the move is going to be less than what majority of the people anticipate, then you're going to lose money. Right? You can do a strangle, right? Expecting move, want lower cost. If you wanted to reduce, wider break-even point than the spreads, right? Lower cost. But again, you have to be careful when you're shorting puts and calls. I would say majority of the people should not sell naked puts or naked calls. But you can do an equivalent of iron condor, right? You can sell put spreads, sell call spreads. You know then what your risk are. Just like I did an example of that spread of the Microsoft spread, put spread and call spread. If you sell a put spread and you sell call, iron condor. If you're a market maker or a professional trader like Keith, okay, you can try to sell naked puts and naked calls if you have a larger portfolio and you've been doing this long enough where you understand your risks. Again, bullish call spread, moderately bullish, right? Again, limited risk, capped reward. But if you think Microsoft is going to move 5% or more, one way to do it would be bullish call spread. If you think the other way around, you can buy a bearish put spread. But these are just basically different guidelines, right? It says Microsoft traded 451, RSI is neutral, MACD is bearish, momentum is deteriorating, that's clear. Support 470, resistance 489. These are short term, right? You know, the move is probably going to be beyond this level, right? Support is below that 471. Implied volatility is typically elevated before earnings. Option premiums are rich, so that's good. Market sentiment is mixed. AI spend is high, but cloud growth remains robust. Right, so good point. So that will be these earnings, not just for Microsoft, is going to be about that. AI spend is high, but does the revenue justify? And risk factor to consider, right? If you long that put and call, then there is a volatility crash post earnings, right? The premium from these long puts and calls will quickly dissipate. Directional risk, if Microsoft moves smaller than expected, long straddles may lose value, right? If you long a straddle and it's less than expected move, then most likely this trade will be a losing trade. Macro headwinds, right? Geopolitical risk, obviously. And position sizing, right? It's all about position size. I would encourage you, you know, if you're doing, you know, maybe $1 spreads, you do 5 contracts, right? If it's a $5 spread, you only do 1 contract. If it's $2.50 spread, maybe you do 2 contracts, kind of always taking the same risk. But start it small, right? Start with 1 contract, right? Some stocks trade, you know, you have increments of 1. Stock like Microsoft will probably be $2.50. So then you would do just 1 or 2 contracts. Keith, any feedback on option strategies? What's your favorite option strategy for earnings like Microsoft?
Yeah, so like with a Microsoft, I tend to look at either trying to pinpoint a repeatable move. So if I think that it's going to move exactly 5%, I may put on a spread that is targeting a move of 5%, whether it's a call vertical or a butterfly. Um, if implied volatility starts to rise more going into earnings next week, which often does happen, and all of a sudden the market's pricing in 6 or 7%, that's where the iron condor can really work out really well because it can get a little bit more premium. Now, instead of selling, say, the example that you had looked at for $1, maybe it's $1.10 or $1.20, and that actually gives me an incremental expected value on my trade that makes it significantly worthwhile for me. Now, if we have a weird thing where implied volatility gets crushed and all of a sudden the market's pricing in that Microsoft's only going to move 2%, well, again, new opportunity for me. But you got to be just flexible and shift around and then I don't like to force myself into saying I'm only doing iron condors on every single earnings because the market opportunity just may not be there. If you only like iron condors, you got to have the right setup to only trade the iron condor, and it's not every earnings setup. So Microsoft may be good for that, where maybe Oracle won't be at their next earnings cycle. So always evaluating that expected move and understanding whether or not it's worth it.
Thank you. All right. And finally, any questions before we get into this?
Yeah,
All
thank
right.
you so much, Vlad and Keith, for the insight. That was a lot of great information. Vlad, I'll ask you to leave that slide up just right here for a minute so everyone can write down the contact information if they have follow-up questions on the specific presentation they want to reach out to you directly for follow-up. Everyone take a snapshot. This will be in the recorded replay as well. You need to go back and get it, but feel free to reach out to Vlad directly with any follow-up questions. I haven't seen any questions regarding the material coming through at the moment, other than asking how to contact you. So this is the slide for that. So definitely take advantage of that. And we are actually, I'm going to go ahead and the screen back. We are going to be having Vlad back on February 5th. So he'll be back again for another lunchtime options trading webinar. We'll get the details of the actual presentation beforehand and update our site. And we'll also send out those invites for those of you who have subscribed to our invitation list. If you haven't done that yet, I'll remind you to do that after this webinar right now on avantgardetrading.com on the education tab. All right. So with that, we are pushing right up against our time frame. Thank you for everyone who joined live and took time out of their schedules. Thank you, Vlad. Thank you, Keith, for taking the time to chat with us all and to further the education coming up to earnings. We appreciate it, and we'll see you at the next webinar. Until then, good trading to everyone.
Thank you. Thanks, Natalie. Thank you, everyone.
Thanks, everybody.